Hi everyone, my name is Hurma, AK, and I'm an ACCA member. I've had a total experience for about 10 plus years, and today I will be, recording this very simple topic of double entry bookkeeping from this very first paper, FA1 in ACCA. So this lays down the foundation for your accounting, and definitely whatever you gather in this particular paper, you're going to be using it going forward in the other papers, like in papers like FR, EE, audit and assurance, financial reportings. These are your higher level papers in F foundation level itself. And then you will also be using this knowledge in your P levels, your professional levels. So this is a very important core paper, very simple to relate to, yet very important at the same time. So let's quickly dive into it and understand what this whole concept of double entry bookkeeping is all about. So, first of all, you all need to understand that every business will have a lot of transactions, right? So, every transaction needs to be recorded. That's the basic that you need to know in accounting. And every transaction that you record is going to have two effects, right? And they're all going to be reported in the financial statements because recording of every transaction is very, very important. That helps you to understand that how much of profits have been made during the year and how much is the revenue. If there is a loss, then what is the next decision or what are the next steps that the business needs to make, so on and so forth. So the first prime factor that you need to know is that every transaction needs to be recorded. And this process of recording is what is called as bookkeeping. Yeah. So this is what is bookkeeping. Now, I have mentioned that every transaction has two effect. What does that mean? We will be looking at it in some time, what that means really. Well, for if I have to give an example over here, let's say that you made some purchases, right? You purchased, obviously, you will require raw materials. You'll require, if you're going to start a business into restaurant or hotel, so you'll definitely buy raw materials like, food items, ingredients, etc., to make food. So definitely the purchases are going to be made. So that's an expense for you, and the money is going out. So cash is reducing, right? So expenses are increasing. That's one effect. And the cash is reducing. That's the other effect. So that's what I mean when I say that every transaction has two side effects. Okay. Now, this whole process of recording the transaction with the two side effect is what is called as double entry system into bookkeeping. And each of this effect will go into your financial statement somewhere or the other, right? Like in the previous example that I mentioned, purchases will go to your profit and loss statement. So in ACCA, we say as statement of profit and loss, right? SOPL. So that's where you will be recording SOPL. That's where you will be recording expenses. And your cash or the money that you have paid to purchase that raw material is reducing. So it will go to an asset. It's an asset. Cash is an asset. So it's going somewhere. It will go to your SOFP. So statement of financial position, which is basically your balance sheet, right? So that will go credit. I will explain to you what debit and credit is and how do we know which account to debit and how do we know which account to credit. So we're going to be, dealing with that in some time. So hold on. We will be crediting bank because our money reduces and our expenses is increasing. So we come to debit and credit in a bit. So just hold on there. So now we know that every transaction could have, uh, you know, two side effects and everything needs to be recorded and they all go to your financial statements. And your financial statement comprises of your statement of profit and loss and statement of financial position, which is nothing but your balance sheet, right? Now, how does that work? What is the flow? So first of all, you have transactions, right? And every transactions when they get recorded, they will be getting recorded in a book, right? You will keep an account of every transaction that you make. So this goes into a book or a file. So we usually have a term for it in financial accounting in ACCA. It's a professional course, so you need to have some really good technical terms to it. We can't just call it as a book, right? So we're going to be having some name associated to it. So we usually call that book as a nominal ledger or a general ledger. Okay. So this book basically is a file which contains n number of accounts, like all your expenses account, all your income account, all your assets, all your liabilities, yeah, all of it. So all of that goes into your nominal ledger, and nominal ledger will then have these separate accounts, and we have a term for it, like it's called as the ledger accounts. Okay, ledger accounts. And nominal accounts are also called as general ledger. What are they called as? General ledger. Okay. Yeah. So the moment you open this book or this file that contains, or the nominal ledger, which contains n number of accounts, such as on cash, on expenses, like I said, these are ledger accounts, and you will be able to know the total, the end balance in each of these accounts. So every account will have some balance, and this is what is a ledger. This is how a ledger account looks like, by the way. It's also called as a T account. So you'll see there's a debit on the left side, right? And there's a credit on the right side of your page. Yeah, can you, I hope you guys have made a note of it. So on the left side of the page, you can see there's a debit, and the right side, you have the credit. Okay, so this is how your ledger account looks like, and there will be some amount of balance towards the end of the year, or it could be on the debit side, it could be on the credit side, it can be anywhere. So you take that balance at the end of the year, you accumulate it, and this goes to your trial balance. A trial balance is a summary of all the balances of all your ledger accounts. Okay, so that means if there is like 10 ledger accounts, such as for expenses is one, for income one, for assets, for liabilities, for different type of assets, etc., you open separate ledger accounts, and then they all go to your trial balance or your general ledger totally, and then this will go to basically your financial statements. You then place them, the financial statements, as per the accounting standards IAS 1. That's they give you the layout of how your financial statements needs to be presented, which comprises of your statement of profit and loss, statement of financial position, and there are a few other statements as well, which we will look into later. I don't want to overwhelm you guys right now. So let's just take a step by step to understand more about accounting. Yeah. So as of now, I hope you guys have understood till here. Do let me know if you have any doubts, or else I will proceed. Okay. Next, we're going to look at the golden rules of double entry bookkeeping. What is this golden rule? So remember a moment before I was mentioning debit expenses and credit bank, and I said I will be talking about it in some time. So that's what this is now. We're going to cover the golden rules of double entry bookkeeping. Now, like as we know that there is always going to be a debit and a credit, and now we need to understand what do we debit and how do we debit and what do we credit? What do we do? Like when do we credit items? So basically, in a balance sheet, and there are going to be few accounts like or statement of financial positions. There's going to be accounts like the assets, and there are going to be accounts like liability, right? And in your statement of profit and loss, there are going to be accounts like expense, and there are going to be accounts like incomes. Several types of incomes and expenses. We will have different categories, isn't it? Now, Some of it will increase, like I said in my earlier example, when you purchase items, your expenses increases and your cash reduces. So when your expense increases, it's a debit. That's the golden rule. It's a rule. You got to follow it. Right, just like how we follow traffic rules, there are certain rules in financial accounting, financial reporting, and the rules are guided by the UK GAAP because we are following we are doing course such as ACC, which is a UK-based course and it's globally accepted in different several countries. So we follow IFRS, right? So we have several guidelines that are coming from accounting standards and a gap, a UK gap, and we need to follow. So we have to follow those rules. And the golden rule number one is that you debit an item or you debit an entry when the expense increase. Okay, so that's what is over here. Increase in the expense. Okay, increase in the expense. Or when your asset increases. When your asset increases also, it's a good thing. So you debit that as well. Or when your liability decreases. Okay, liability decreases. That's the golden rule. And when do you credit an item? You credit an item when your income increases. Okay, so this is the increase in income, or the other way around. Okay, your expense decreases and your liability increases. Your your asset decreases, yeah, and your liability increases. So this is the credit and this is the debit. So you have to remember this golden rule. It's very simple. And as you do more questions, more when you keep solving such small one-liners, when we start writing journal entries, you will definitely get a hang of it. So there's definitely nothing to worry about. For now, you need to remember the golden rule. Debit an item when that leads to an increase in expense, or debit an item when it is leading to an increase in the asset or decrease in the liability, and credit an item when it is leading to an increase in liability, decrease in the asset, or increase in the income. Okay, let's have a look at a few examples so that we should make your, uh, you know, now we're going to apply it, right? So we're going to make the golden rules more stronger. And how are we going to do that? Through more practice, isn't it? So let's look at the first one. Christine starts a business and pays in $5,000 as capital. So here, when they start the business, we are going to be introducing cash into my account. So bank, debit and credit, capital. Okay. So you have to think carefully and open the relevant accounts. All right. So that is something which you need to learn and we will learn over time as you practice. So we will put this as $5,000. Both places, $5,000. We're debiting bank. Bank increases, it's an asset, and capital is coming on the liability side of the balance sheet. Okay, that is something which we will cover in the first chapter. This is the second chapter. So this is actually a demo. So we will be learning about the different accounts first of all in the first chapter itself. So you will know that what are the different accounts, what are the accounting equations. So that should not be a problem, right? So next example is the business buys a car for 1,000 rupees cash. So now car is going to be an asset. So you can write it as car or you can write it as a capital asset. You can debit that. So you debit increase in the asset. And what is getting reduced? My cash or bank, whatever you say. Okay, $1,000. Yeah. So this is my A and this is my B. I'm just going to be making it a little presentable so I don't confuse y'all. The next one is the third one is they buy goods for resale for 5,000 cash. So something similar to my very initial example, isn't it? So can you all tell me what this is going to be? That's right. Debit purchases We're going to be debiting purchase. So we'll open a purchase account here because we are buying goods for my business. So it's an expense. When my expense increases, I will be debiting it. And you credit what? You credit bank because my money is going out. So that is decrease in the asset, right? So decrease in the asset is definitely a credit. It's a golden rule. That is going to be $500. Okay. D part. They buy more goods for resale for $600 credit on from Mr. A. Now this is interesting. This is on credit. This is not on cash. Is that possible? Of course it is possible, right? We can buy goods on credit. We can buy goods on cash, right? That's very much possible. So what do we do now? The same thing. I'm going to copy down the same thing, just that we're not going to create, we're not going to credit bank because over here I am now incurring a liability, right? I'm incurring an obligation to pay to Mr. A, and he is going to be my creditor. So I am going to credit Mr. A's account. Yeah. What did I say? Mr. A is a creditor, and a creditor, he is my obligation. And if he is my obligation, my liability is increasing, right? My liability is increasing. All right. So when my liability increases, I credit. Isn't this interesting? It's actually a very interesting, it used to be my favorite subject back in my higher secondary school. So I don't know in which part of the world you are, but we used to call it as plus one, plus two. So it's just before your degree, you start your pre-university classes, right? So yeah, it used to be my favorite subject and a very interesting one as well. Let's move on to the E one. They pay rent for $200 cash. So you're paying rent. What are the two accounts you're going to open there? Rent, yes, that's an expense, and cash. So what do we debit? Rent, because it's increasing, that's right. And what do we credit? Cash, cash or bank, right? That's going to be for $200. Okay. F, what is the F transaction about? They sell half the goods for 800 cash. So whatever they had purchased earlier, now they're going to sell it. So we're going to get some income. We're doing some business, aren't we? So we debit. What is the account that we open there? What are the two accounts that are getting affected in this transaction? We're getting money. So bank is definitely increasing my cash balance. I'm booking a sale. So that's an income. So we credit that. Increase in my income is sale and bank balance increasing. So asset increasing is a debit. It's for 800. So remember, guys, that you're going to be following the same structure. You first do the debit and then do the credit. Debit comes first and then comes credit. That's how your journal entries are going to be framed. All right. We're going to go side by so that we don't lose out on the screen. We're going to do G. All right. What is G? They sell the remaining goods on credit for $900 to Mrs. X. Interesting. So we have not got cash, but we're going to be receiving some money from somebody called as Mrs. X. So we can't, we we do open general ledger accounts for individual customers and suppliers. So we will learn that later on, when we get into the details of financial accounting. But for now, we need to understand there's a term that we give to such customers to whom we have sold goods on credit. Okay, so we're going to learn a term today, the term that we use for such customers to whom we have sold goods on credit are called as debtors, right? So we debit debtors because debtors are our assets. It's increasing here, and we credit sales. Yeah, that's for 900. Yeah. All right, let's look at the next transaction. They pay 400 cash on account of the amount owing to Mr. A. Yes, remember we had purchased some goods on credit from a vendor called Mr. A. Now we're going to make payment to them. So this is interesting here. This was in this particular transaction, right? Transaction D, which I have highlighted here. We're going to make payment. So we're going to reverse my liability because my liability is reducing. So Mr. A, and I'm going to be giving away my bank balance. So that's reducing. That goes as a credit. So Mr. A is going to be 400. Yeah. Now, why don't you try I and J and let me know what you think? If you're able to get a grip of it, give a pat on your back. If not, we will definitely, you know, master this in no time. So, see you in the next class, hopefully. Till then, take care. Bye bye.